Sometimes the best stock ideas are in companies that you've never heard of. Take Griffin Corp, for example. You can see that this company, since 2011, has grown earnings at over 18.59%. And when you correlate stock price with those earnings, you see that the market has typically priced this at a premium valuation until the last couple of years. This gives us a great opportunity to buy this stock at a discount to its intrinsic value and with a clear margin of safety. Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. I want to welcome you once again to a Subscriber Request Tuesday. On March 15th, I did a video called 33 Dividend Aristocrats That Were Crashing. How Far Can They Drop? It was the title of the video. And I had one subscriber, Steve Gajewski, and I hope I pronounced that right, Steve. If not, I apologize for butchering your name. He said, Chuck, if these are the dividend stocks not to invest in, which are the dividend stocks we can invest in with a margin of safety? So I've put together a couple of lists of stocks. I'm doing that constantly. I do that routinely as part of my everyday investing life. But what I've done is I've come up with a group of stocks that I believe are really excellent dividend growth stocks, number one. I also think they're really good total return stocks, and the majority of them do provide a margin of safety. So then let's go ahead and get into the list. Now, I'm going to point a couple of things out before I do that. When I do 20 names like this, I'm going to be covering 20 stocks in this video. I do it at a very high level. I do it just to give you a perspective as to whether or not these stocks are, what I call research worthy or not. Are they stocks worth looking into for your behalf? And the idea is, as a value investor, Mr. Valuation, I'm always looking for stocks that are in value, but I do want you to understand something. Not all the time, but typically when you're in a bull market like we've been in, for the last several years, and I've talked about this a lot, if you're looking for undervalued stocks or fairly valued stocks, you're typically going to have to look for stocks that are unpopular. That means these are the stocks that for whatever reasons, and they're all different for every company, they've actually dropped in value recently. And that's what creates the opportunity. As Warren Buffett once so aptly put it, you want to be greedy when others are fearful and fearful when others are greedy. But the key is to find really good companies that you can exercise that strategy with. Okay, companies that have good fundamentals, that are growing their earnings, growing their dividends, and have done it at a relatively consistent and above average rate over time. These are the things that I covet most. So let's go ahead and go through this list rather quickly. And again, I'm going to do it high level. Now, I also want to add one other thing before I go any further. I'm choosing these companies specifically for their high total return potential. These are for the investor who's looking for growth in their portfolio but likes dividend growth stocks. Now, having said that, there are some that would also be available for income investors. Okay, I want to point that out. But the names I'm covering right here are primarily oriented towards capital appreciation primarily, with dividend growth and dividend income secondarily. And the idea that these companies would grow into their yield over time if you were, say, 15 or 20 years away from retirement. So let's go ahead and look at the names. The first one is Abbvie. Now, I chose Abbvie because Abbvie actually fits the bill for one of those, what I'll call hybrids. You could invest this for an income portfolio-oriented portfolio. You could also invest in Abbvie as a total return portfolio, and it does offer a margin of safety. Now, I want you to note something on Abbvie. The company's grown earnings since 2013 at a rate of 11.46%. That's almost twice as fast as the market. Okay, the company's stock price tracked in line with its earnings growth for most of those years up through 2018. And then we got into this situation where Abbvie's stock got really undervalued, and it stayed that way for several years. Just like many of the overvalued stocks today are trading at premium valuations and have for years, Abbvie has been undervalued for several years, but since it's been undervalued, it's been simultaneously a really good investment, generating really attractive rates of return. I'll just give you one quick calculation. I'm just arbitrarily picking 2 points here. There's a 33.2% annualized rate of return since June of 19. Okay, and you can see it's done that during a time when the original PE was under 10 times earnings. So it's been very cheap. It's been undervalued. It's provided a really good margin of safety, and now it's beginning to move back to intrinsic value. So some of the margin of safety has disappeared. if I'm looking at it from a forecasting point of view, I still have a margin of safety. For the next year or two, I still would expect pretty decent rates of return. However, Humira is their big drug coming off patent. You need to be aware of the fact that there could be some issues and some negative sentiment, negative news happening in 2023 or 2024, unless they replace that revenue somehow, and they always have that possibility of doing that. So anyway, that's AbbVie. That's the first choice that I'm looking at. The second one is AmerisourceBergen. Now, AmerisourceBergen has also been a very strong growth stock since really going back to 2002. It's averaged over 14.4% growth rate. You can see it's typically traded in line with its earnings growth. It got overvalued in 2015. Then it was reasonably valued for a couple of years, and then it got undervalued during the opioid. It's a healthcare distributor, drug distributor, and it got cheap. But again, that was the best time to buy it because you had a margin of safety here, and then the stock has, as I say, they always will eventually do, it moved back into alignment with its intrinsic value. Some people call that reversion to the mean. I like to think of it as reverting back to its intrinsic value. I don't think the market's always efficient, but I think the market's always seeking efficiency. So, AmerisourceBergen now, maybe the great opportunity in this one has disappeared. This would still be an attractive investment capable of producing 9 or 10% rates of return if these forecasts are correct. But I did want to point out this is one that really provided a great margin of safety. It's still investable today, but some of the real opportunity in AmerisourceBergen has disappeared. It offers a 1.2% dividend yield, earnings yield right now of about 6.5%, PE ratio, blended PE ratio 15.34. This is a very good BBB plus rated healthcare distributor, and it's one that I actually hold in my own portfolios, but I've bought them when it was inexpensive. I do want to make that clear. Ameriprice Financial is another one that you can see how closely earnings and market price move in tandem together. You can see where the stock really got a great margin of safety back here in 2020 during COVID. We saw the flash crash, but we saw a really quick recovery. The stock has fallen down a little bit. Earnings growth is expected to be very attractive going forward, over 13% this year, over 15% next year, and still double-digit 10 to 12% the following year. So the company does still offer us a modest margin of safety, about 10% or so, and does give us the potential, coupled with the growth and the 1.5% dividend and the low valuation, the high earnings yield of 7.8%. We've got a really tremendous opportunity here still going in Ameriprice Financial. This was a spinoff from American Express. You can see it's got good, consistent earnings growth. Occasionally it stumbles, but forecast numbers really look attractive in this company. We're looking at over 13% earnings growth, on average over the next couple of years, as I've already mentioned. So Ameriprice Financial is another one that I really like. Best Buy is a retailer, obviously. Retailers do have certain periods of time where their business runs into a little trouble. You can see that happen with Best Buy. You can also see that the stock price got very inexpensive when they had a couple of down years of earnings. Now, if you were, greedy when others are fearful, you could have purchased the stock in these valuations with a great margin of safety. It then tracked earnings very well. It did give us several opportunities to buy it with a margin of safety, and I believe it's giving that opportunity right now with a year that's expected to be flat to down this year. So if you're looking at the consensus, the estimates are for about a 10% drop in earnings, followed by 18 and 18% the subsequent years. This gives us a really tremendous opportunity to get PE ratio expansion, a dividend yield of over 3.55%, which I attribute to the undervaluation that the stock is trading at, earnings yield of almost 10%, and the blended PE is just barely over 10. Best Buy looks very, very attractive to me here. The next candidate that we're going to look at is Bristol Myers. I feature this. This is another one of those, as was Best Buy, where you can buy it for the income. It offers over a 3% yield, which is still attractive even during this period where the Fed's raising interest rates. The company is beginning to generate some really strong earnings growth. The stock price has been available at a good margin of safety for the last several years. You can still buy the stock at a great discount with a great margin of safety. I've been featuring this one several times, offers over a 3% dividend yield, 10.66% earnings yield, PE under 10. I think Bristol Myers is really a slam dunk here, and it's an A+ rated company. So I really like Bristol Myers. The next one is Cigna. Cigna has been primarily a growth stock. It's only just started paying dividends. It's too early really to tell how strong the dividend growth might be, but it does offer a 1.8% yield, an earnings yield of 8.59%, and a PE ratio of under 12. Forecast growth for this company is considered to be a very attractive 10.8%. That gives us a margin of safety with the premium expansion and a possible dividend continuation. Although we're not expecting a lot of growth in dividend, but we are expecting some. This could be a very attractive time for total return on Cigna, and this company could very well morph into a really powerful dividend growth stock going forward. But it's been a growth stock that's already morphing into a dividend growth stock. Cummins is our cyclical, diesel manufacturer. Most people are aware of it. You can see the earnings have been somewhat cyclical, and the stock price is volatile from that perspective. It got overvalued, March of last year. It's now already corrected. It's created a nice little margin of safety. So I think this would be a good time to buy it, and probably, looking at double-digit rates of return for the next couple of years. On Cummins, you can get almost a 3% yield, 2.81% yield. Earnings yield 7.42%. So Cummins is one that I suggest you might want to take a closer look at. Fortune Brands, I really find this one to be very intriguing. And it's one of those stocks, like I said in the introduction to this video, a lot of people aren't aware of Fortune Brands. It might be worthwhile to take a quick look into their website real quick for you so that you kind of understand what this company does. Their brands are actually, they've got plumbing, outdoors and security, cabinetry. So with the housing boom going on, Fortune Brands has obviously been doing very well. You can go to the website yourself and look more into the company and what they do. But you can see they've grown earnings at over 22% a year, going back since the beginning of 2012. The stock price has been offering a really nice margin of safety. And this is a good time to interject a point. Value investing is a long-term strategy. It's not about making money in 6 months or 3 months or 1 quarter or 2 quarters or 3 quarters. It's about making money over a business cycle, over a 3 to 5 year minimum holding period. Emphasize minimum holding period. So what you want to do is you want to buy a company when it's inexpensive, let the earnings and dividends build up underneath your investment, and your investment will eventually move into alignment with those earnings and dividend justified valuation. We can buy this with a really significant discount right now. Earnings growth is expected to be 11.5%. So technically, if you're looking forward, it doesn't offer a really great margin of safety. From a historical perspective, with 20% growth, it looks very attractive, but it looks attractive on both sides as far as I'm concerned. It's a good double-digit rate of return, 1.35% dividend yield. PE is under 14. But what's changed here, this is so you understand what you're looking at. We have historical growth at 22%. We have forecasted growth at half of that rate. So you always want to take those things into consideration, but I still think this is a really quality company, BBB+ rated. It's still involved in a very strong housing market that's I think going to last for a while. And, the stock has now, come into alignment with fair value based on that future, and it would be tremendously undervalued based on its historical numbers. The next stock I want to look at is FedEx. I featured this several times. FedEx has really gotten inexpensive here in the last year or so. That gives us a tremendous margin of safety. Earnings yield over 9%, dividend yield over 1%. Looking at forecasting growth going forward, I think you've got double-digit, 11% growth. This would give us really extraordinary rates of return in the 20% range if we got this reversion to the mean and PE ratio expansion coupled with 11% growth and a 1.35% dividend increase. Griffin this is the company I featured in the beginning. I do want you to note that it's been a relatively cyclical company historically, but for the last decade, for the last 10 years, and I've got 12 years marked here because I'm looking at forecast years, you can see this company's grown at over 20% a year, offers a very strong margin of safety. The company's forecast to continue growing at 18% a year. I just don't have a dividend forecast here for 2024, but obviously from between now and the end of 2023, we offer, exceptional rates of return potential on Griffin Corp. And Griffin Corp is another one of those companies that it's worth going to their website and looking at them. If you're not really familiar with this company, they do have some very interesting businesses. Their Clopay company I call it Home and Building Products. You can just click on there and see that they have, everything from garage doors, entry doors. So, they offer that element there. Then you can look at Defense Electronics. The company is involved in electronics with surveillance and so on with government communication services, ground surveillance, and then they have what they call their Innovation Center. And then, of course, what I failed to cover here is the Ames brand. Ames brand, a lot of people would know them for their tools, their rakes and shovels and so on. We can take a quick look at those very quickly here, and you can see that, they offer rakes and shovels and different instruments for the home. So it's a good basic, what I like to call, meat and potatoes company. It does offer a very attractive valuation today. I like the fact that the company's earnings growth has been strong for the last decade, and I like the fact that the company is available at a margin of safety, and I like the fact that the company's forecast to grow at over 18% a year. One thing, the analyst scorecard of this company is not that great, so I do want to point that out. This has been typically a very difficult company to forecast. So don't just take what the forecasts are showing you. You want to get in and do a little research on your own if you're looking at a stock, but that's always my recommendation. I do want to make that clear. Anyway, there's Griffin. Magna International is auto parts and equipment. Moderately cyclical, but it's had, double-digit growth. Through COVID, it had a couple of bad years. The stock rallied, got overvalued. It's now become undervalued again. I believe this is a great time to buy this company with really an extraordinary expected growth rate going forward. If you know about the automobile industry and the scarcity that's going on there, Magna looks like it's really well positioned. You might want to take a real close look. You can get almost a 3% dividend yield, earnings yield of over 8.6%, blended PE of 11.61. I really like this one right here at these levels. You do have a very strong margin of safety here. Altria, Philip Morris, the old Philip Morris. It's now called Altria. They still have the symbol MO. It bugs people when I say that, but I always think of them as the original Philip Morris. The company's got good 7 or 8% earnings growth. I think the real story here is 5 or 6% growth going forward, but it does offer almost a 7% dividend yield, 6.89. This is one that is a pick of both, but looking at the margin of safety it offers some very, very strong total rates of return potential based on the fact that it does come with a really great margin of safety built in. So you might want to take a look at Altria, or AZ, as I call it, Philip Morris. Omnicom's another one that if you look at it historically, this company has quite often traded at a premium valuation. You can see that by the blue line being higher than the orange line. It's currently under the orange line. PE ratio is 12.5. The dividend yield is 3.34%. Earnings yield almost 8%. I find this one real attractive. And again, it's got about 5% growth expectations, but you add that with the 3% dividend yield and the margin of safety, you can easily get double-digit rates of return over the next several years out of Omnicom, which is basically an advertising company. So I like it. It's a very high-quality company. Been in business, got good dividend growth. So you might want to take a closer look at Omnicom. Progressive Software is a software company, system software. I don't know a whole lot about this one. It's one that I'm currently in the process of learning a little more about. But again, when I say something like that, it always pays, to go into the company's website and learn about, what the products do, what their different products are, so you can kind of get a feel for it. I'm in the process of doing that right now for this company. But I do like the fact that it's, undervalued with a blended P of 11.6, a dividend yield of 1.5, earnings yield of 8.6, and it does offer double-digit return potential. The key is we're looking at undervalued stocks in an overvalued market. Please keep that in mind. Qualcomm has had a nice surge in earnings growth. Again, you can always see how the stock price tracks earnings of these companies. It does get disconnected temporarily, but it usually always moves. So you can see when a stock is highly valued like Qualcomm was back in 2004, you end up with poor results even if earnings grow and even if the dividend grows. But you catch these stocks when they're cheap, even if their earnings don't do well, you can end up making a lot of money. This stock was reasonably overvalued. It's now reverted back to, its earnings growth rate. So we do have a double-digit rate of return here, dividend yield of 1.75%, earnings yield of 6.49, and the PE right now is just a little over 15, and the earnings yield is just a tad lower than I like, but I think Qualcomm is a really good buy here at these levels, considering how the market likes to put a premium. Stanley Black & Decker, historically, this company's got really good growth, a little bit of cyclicality every now and then, but generally it's been a strong 8% grower. You can see that the stock gets overvalued from time to time. You can see what happened during the flash crash of COVID and how quickly it recovered. It's now inexpensive again. You can look at it for 9 to 10% earnings growth and good double-digit returns going forward with a 2.1% dividend yield, blended PE 12.98, and earnings yield just under 7.75%. I really like Stanley Black & Decker here as a really basic stock. Skyworks Solutions, another one that was recently overvalued. It's had a nice correction. Again, these are the stocks out of favor now. Now's the time to buy it, especially if the earnings growth going forward ends up manifesting at 9.5 or 10%. You can buy this stock at a PE of 12, slightly over 12, a 1.66% dividend yield, 8.17% earnings yield, and you've got built-in really strong double-digit rates of return out for the next couple of years based on good growth and the fact that you can buy it at a very low valuation today. So that's Skyworks Solution, a semiconductor company I really like. This has been a really interesting stock over the last several years. You can see how the market really valued it. It's a gas utility. We've got everything going on with the Ukraine war and so on. Apparently has caused a temporary drop in this stock price. Earnings are expected to be flat, but then recover. I think you're buying this stock at a PE under 12, a dividend yield of almost 4%, earnings yield of 8.37%, forecast growth about 6.5% with a very strong margin of safety built in. And then I want to take a look at Walgreens Boots Alliance. We've gone through all the opioid epidemic stuff. This stock has been very inexpensive for several years. I would say even here would be a good time for the long-term investor to have accumulated this stock. Performance wouldn't have been good so far, but right here at the bottom would have been a great time, obviously, to buy it. That was during just coming out of COVID. But right now you can buy Walgreens Boots Alliance, at a PE of under 10, earnings yield over 10, dividend yield over 4%. Not expected to have a lot of growth, but the real play here is PE ratio expansion. Because if you look at the stock historically, it had many, many, many years where it traded at a really premium valuation when earnings growth wasn't much better than it's expected going forward. So, it was overvalued. This is a good time to buy the stock with the potential for that valuation. Last but not least is Western Union. And what I like about this is a real valuation play. Dividend yield over 5%. Blended PE under 9%, earnings yield over 12%. And the key is it's not forecast to be that fast a grower, but the stock is so expensive, even a no-growth stock, I believe, deserves a 15 PE ratio. And here I'm measuring it only at using the Graham-Dodd formula at a 12 PE. If I measured this at a 14 or 15 PE, you can see the rates of return potential here would be really exceptional over the last couple of years. I believe this is a speculation worth taking. Western Union obviously is money transfers, but the point is, for people living overseas and stuff, they still rely on Western Union. It's solid. It's not necessarily a fast grower. It's got a good credit rating. I like this stock at these prices. Anyway, this has been Chuck Carnevale bringing you another Subscriber Request Tuesday. These are, 20 names that I think you can look at for total return. I've also got names that I'm looking at for income. Many of these already foot that bill, if you will. But what I'm looking at is for fairly valued or undervalued selections that you can buy that give you a good margin of safety and an opportunity to grow your money over time. But remember, value investing is a long-term strategy. You want to give a value investment at least 3 to 5 years. One thing you usually got to do is wait till it turns hot again, and they inevitably do, as long as the earnings and the dividends and the cash flows continue to hold up and continue to progress. When that quits happening, that's the time to be concerned. But otherwise, value investing, I believe, is a really great strategy. It lowers your risk and simultaneously increases your rate of return. Anyway, rather long video today, but I hope you enjoy it. I appreciate it if you did. Give me a like, ring the bell, subscribe to the channel if you haven't already. This has been Chuck Carnevale presenting 20 dividend growth stocks for total return, most of them with a nice margin of safety that you can invest in comfortably, even with all the turmoil that's going on in the market today. Thanks for watching.